Hey everyone, welcome. Man, I feel so off today. I had a crappy night's sleep last night. It's because I think my body's taking in too much sugar, so I feel a little groggy. But aside from that, I had a good workout. I already ate lunch, a couple hours ago, and I feel good. I feel good otherwise. All right, so first things first. So they have the press conference at 2:30. The interest rate decisions in like 13 minutes. Fed to adjust interest rates in 13 minutes. Live now. I gotta get the link for this because I thought they're gonna have the press conference at 2, right as they release the thing, but turns out they're just going to do. How do I get the link? View and live control. No. I need, okay, details. Okay, video link. I don't know, is this right? Okay, maybe I do need to actually use this thing. Hold on. Connecting Cheyenne to go live view. Alright, so I need the... I love how this doesn't tell me the link to this page. Alright, I'm just gonna have to hope this is the actual link. Just turn on the air conditioning. Live now to see this crap show go down. Alright. I forgot to close the bathroom door. That way all the nice expensive air conditioning air doesn't just fly out the window. Oh, alright. Oh yeah, thank you again. All the new people they're kind of popping in, especially on Twitter, right? Mostly from our friends and brothers and sisters from Brazil. I really don't want to take this pinned tweet down, but I mean it's been kind of slowing down. But I mean on the other hand, though, my notification is still just like completely like really difficult to whatever. Alright, so anyway, since they're not even going to say anything for like a while, I figure this would be a good time to just let people catch up, because people usually don't jump in until I actually open up Chrome so it doesn't white out the thing again. Yeah. So anyway, it just gives people a chance to just jump in. So first things first. Alright, so the Fed is what I thought they were doing, which is buying the debt. Greg Manarino confirmed that today. And yeah, at one point, like all of a sudden, U.S. Treasury yields just went down like 10 to 12%, right? Well, 0.10 to 12 to 0.12%, right? I instantly knew that had to have been the Fed. Then I went to bed late, woke up really early. I only got like 4 hours of sleep last night, so I'm a little, groggy. And then, it turns out that the European Union, right, because they're 5 to 8 hours ahead of us here in America, yeah, they were outright saying they were buying debt, specifically the Italian bond markets, because of something called fracturing or fractionaling or whatever. It's like something like fractions, or fracturing or whatever, right? Because basically each I guess former independent nation in the EU, like Germany, Italy, France, they still have all their own little different bonds. So it was causing like a cascade domino effect. So that's why the EU had to like go in and like the EU central bank, that is, had to go in and like buy up debt, and then the Federal Reserve is doing the same thing. So I saw a link on Twitter which is pretty handy, which is this. Like, this is actually from the Commodities Chicago. I think no, that's CBOE. This is from the other commodities exchange, right? CME Group. So they actually have like a kind of like betting. It's not gambling, because I don't think you pay money for this. It's just a survey of what people think is going to happen, and then basically this is where everyone was citing their sources for like 75 basis point rate hike. So So 50 and below, and I believe 100 and above. I think I think the stock markets are going to absolutely hate it. All right, because again, whatchamacallit, despite the Fed's efforts to boost this number, the debt market is still imploding, right? It's just that the Federal Reserve just happens to have more money, right? But at some point they're gonna run out of money, right? Because again, the more that the Fed does this, the greater the inflationary risk. That's why we have inflation, right? Because the Fed's been doing this crap for like, decades or whatever, aka easy money, which was propping up the stock market. Now the problem is, I think the stock market has kind of figured out that this is bullshit, right? Now the stock market could still go up a lot today, but I might actually buy some more shorts on SPY. I don't know. I'll make a decision after 3 o'clock. Because here's the other thing. Cryptocurrencies continue to slowly go down, right? MicroStrategy was actually bucking this trend for a little while, but now, it was up like a crap load, like, plus $15. Now it's coming down because, Bitcoin cryptocurrencies are dragging everything down. So I'm thinking that there's enough smart money people out there that realize what's going on and this is all bullshit. So everyone's just dumping shit before, before the grand finale, like Greg likes to say. So today is definitely going to be a dead cat bounce. But yeah, I'm not going long on this. I'm not going long. I'm going to be looking to short today. All right. Or if the markets do tank right as the interest rates come out and then Jerome Powell does his little speech thing at 2:30 and then, the markets, tank down anyway, I'm going to just do nothing because I already have enough short positions. You need to watch Tron stablecoin. Did they even have? I didn't even know they had one. What's the name of Tron stablecoin? I mean, TRX is at like 5.5. I don't know. I haven't actually seen anything on Twitter that indicates that Tron is like bad, like say Tether, because Tether is actually the one that I'm watching. Because once Tether goes, right, everything's going to tank. And then after that aftermath is done, then I might consider buying Bitcoin. Well, cryptocurrency specifically. I don't know. I literally have never heard of USSD. So, well, since we're still waiting on number 54. So it's actually right on the front page here. All right. Circulating supply is 723 million, 24-hour volume. Market cap is 702.4 million. All right, let's see. What is it backed by? Because that's really the only thing. Oh, this is already bad. Look, it's not even at $1. It's like 97 cents, which is almost like $1. Yeah, this. Yeah, this. Only 70 million. This is easy for Tron to manage. Plus TRX can create billions of coins. TRX will be final. It's just FUD. It's just ignorance. Yeah, this already looks bad. I wouldn't touch this shit. Like this looks exactly like Do Kwon Terra Luna shit. Yeah. But yeah, I mean, I thought that Justin Sun also runs DLive, so they're not exactly the greatest either. It's like, I don't know. I'm just like a little bit of an annoyed mood simply because I didn't get enough sleep last night. So, and that's the other thing too. I'm also exhausted from just keeping track of all this stock market stuff, which is why I want to. I mean, as much as I love doing it, it's still pretty hard to make money off of this stock trading stuff using the unusual whale stuff. And even if you do, it takes up so much of your time. So, and then it just makes me not want to do like any work because I'm just too tired. All right, and then that affects the channel. So I'm probably just gonna scale back, and then depending on what happens, I'm just gonna go back to just trading spiders and just leave it at that. But yeah, it already doesn't look good. All right, now let's see. Now on the other hand, USDC is actually backed by US dollars and short-term, like 1 to 3 months treasury bills. That's it. They don't do commercial paper or any of that synthetic crazy stuff, right? That's why this is at $1. All right, Binance Dollar is probably the same thing too, and so is DAI stablecoin. Right? There should be no reason why, if you're running a stablecoin, that this is happening right now. Like this is without doing any other research, I can already tell that like when this shit implodes, right? As the Federal Reserve is desperately trying to prevent right now, and it will implode, just a matter of when. Yeah, this this USDD thing is just gonna go the same way as Terra USD. So, yeah, but again, I still find it weird. Everything's going up except this. Crypto continues to go down. That tells me there's something wrong. Or I guess maybe they're just like paranoid or something. I don't know. Alright, it's 3 minutes. I mean, if there's not really a lot of chat activity, I really don't feel like talking to myself for the next 30 minutes. You know, it's hot, I have the AC on, I'm already starting to sweat in this t-shirt. And I think I realized why I'm like hot and sweaty all the time. It's because my body's overweight. So because of all that extra body fat, it makes me hotter. Because I just came back from Target and I actually saw like, you know, a bunch of good-looking girls, right? But they're thin. They weren't sweating at all. It's like they can't be that much different from me biologically, aside from men versus women, right? But I think the obvious difference is they're thin and not fat, but I am. And I did read that yes, the fatter you are, the more you sweat and the more body heat and weight that you exert. Are you buying Dogecoin when it reaches 1 penny or lower? Definitely lower. Because I just don't understand. Here's the thing. I know Greg says that when this debt market implodes, crypto's going to surge along with commodities. I don't know, man. I just don't see that right now. I just don't see it. But with that being said, there is a point where if Bitcoin, let's say, crashes to 10K, I might actually want to buy crypto. All right? Excuse me, specifically Dogecoin. Maybe Shiba Inu, right? But, you know, I'll definitely pick up some Dogecoin. Now, what's funny is DeFi projects are all, like, draining TVL, right? So BNB miner is the only one that's actually going up in TVL. It's already almost at, like, 5,000. So that's my exposure to crypto. And, of course, I have my Sphere, right? I'm not touching my Sphere at all. Oh, that's the other thing, too. I'm definitely going to buy up a lot more Sphere as well. But, again, until I see that cryptocurrencies are clearly going up while the debt market's already imploding and the stock markets are crashing, you know, I'm just going to wait for that. All right, it's around 2 o'clock, so we should already have, like... No, this is me. Let's actually go here. You know, as much as I don't like that they're using a algorithm, I do actually use this now, the home page. It actually works out pretty well now. So, here's what it is. CFO from Ford says auto loan delinquencies are increasing. Yeah, that makes sense. In fact, I got an email today from my landlord. They actually said they're raising the interest rate transaction fee from 3% to 3.5%. That's in addition to my rent already increasing too. Houston had planned a shift to testify at his trial. Sure, yeah, I don't even give a shit about that. 75 BP into a recession. Well, funny enough, like Greg said, the recession's a step up. Who's this guy? Attorney General Stacey in order to last thing he won his primary phase of uncontested general election and will be headed to the state legislature. Whoa. Holy shit. So he actually sniped an actual government position for free. How is it possible that you have an uncontested election like this? This is like the first time I've actually seen an uncontested election that actually mattered. Huh. Wow. I should actually look into something like this. Okay, Poon says he and China have agreed to expand. Yeah. Of course, the price for misclicking doesn't help. They're getting rid of... Yeah. I love that Elon Musk is from Africa, so we can actually say African American. I bought some more dog on Mars. It's my YOLO play for a few bucks, see what happens in the next bull run. Yeah, you're going to be holding it for a long time. Your channel finally got monetized. Are you getting rich? No. I mean, it pays for like, I don't know, I don't know, I think it makes like $100 a month or something. It's nothing great, but every little bit helps because if yield, if crops yield farmer goes down because their TVL keeps draining, um, yeah, I'm actually going to be in financial trouble at that point because crypto is just too, is crashing too much for me to, sustain myself through this. So, unless BNB miner like just keeps skyrocketing, to compensate for BNB itself going down, but okay, still have this muted. Okay, why do I not have, there's got to be something here. Someone's going to have it. Fed hikes rates to 75 basis points. All right, let's see what happens in the debt market. All right, so they raised the rates 75 basis points. Yeah, it's exactly what I thought because that's the only winning move. 3/4 point, the biggest increase since 1994. 10-year yield 3.416. That's the thing too. Since late last week, I was doing nothing but watching stocks and the CNBC page. It was insane to see in real time the debt market implosion. Okay. You can use $100 a month your YouTube earnings to buy more crypto. I mean, what it means is I'll just simply just take less money from my crypto to my fiat account, right, to my bank account, and just use that instead. It's the same thing. So, Fed should hike 1 to 2, let's get it over. No, they can't do that. Like I was saying before, the reason why they can't do that is because of this. They can't set off the debt market. Why was the debt market imploding in the first place? Because the smart money was like, the Fed has to raise interest rates by 75 basis points. And that took the 10-year yield and everything else. Look, it's imploding. It's imploding already. Look, it's already imploding. It's going up now. It's going up. So Jerome Powell, he has to say some serious mumbo jumbo to save this because I don't think he's. Yeah, look. I think we're going to be streaming until 4 o'clock because I just need to see this happen. Watch. You're going to watch the stock market just plummet now. You're going to watch it plummet. Yeah, it's already going down. All right, my short positions. So maybe I will be able to make money off of unusual whales. I don't know. We're just going to have to see, man. We're just going to have to see. More work for me. Wait, where are we? Yeah, we need to watch. Yeah, look. It's over. It's over. Look, this is the first green all today. I mean, these two were red and they were green. Yeah, it's over. It's over. Oh, what's the price of Bitcoin? Yeah. See, this has already been going down already ahead of the decision, so we got to give this a little bit of time to work itself out. But yeah, crypto was under a lot of pressure already for some reason. So that told me right there that, today was going to be a bloodbath. But there's a possibility because of all the manipulation, right, from the central banks, that maybe the stock markets would go up and crypto would keep going down. But it's pretty obvious to me that crypto is going to go, it's going down. It's going to go straight down. Markets are already on their way down, right? All right, just gotta give it a little bit, but we gotta wait and see what the Fed does because I assume the Fed right now is still trying to buy bonds right now because they were prepared for this moment. So, all right, I mean, we'll see if they can succeed. Actually, let me check my email, see if Greg said anything. Only cheap being there, I suppose. Yep. Also, I'm on YouTube if you want to hang out for a bit watching this shit show. Alright, so it just says I'm live now from YouTube. Alright, so Greg hasn't sent anything out yet. Alright. Man, we have to wait like 30 minutes for this. When do you enter Seifu? Blockchain is coming in the end of the year. They delayed it by the end of this year. Yeah, I'm not touching Seifu for a while, it looks like. I still keep track of Seifu, but right now I don't want any crypto. Obviously, I have crypto positions, so I'll obviously keep that and compound it, but right now I just want US dollars. Or something that I can use to short the market. I don't want anything else. I don't want anything else. Yeah, I mean, look. I mean, this shit's already going down. I mean, the problem is, like, coin market cap just, like, keeps showing, like, every time I have to refresh the page, it keeps showing up. Okay, there you go. Now we got the real price, 20,736. Once Bitcoin crashes below 20,000, that should put enough pressure on MicroStrategies. Yeah, MicroStrategy is already going down again. All right, good. So yeah, they can't do anything. They can't do anything. Actually, let me check the Fed. Oh, okay, Greg Manuel just posted an email. Let's see where this goes now and watch the 10-year yield. Okay, yeah, that's what we're doing here. Yahoo Finance on Chrome. All right, I really don't want to see these ads with like beautiful women in bras. Okay, so yes, everything except Pinterest is starting to go down. Yep. Okay. Yep. Very good. Yeah, SPY is already heading down too. Yeah, exactly. I don't trust SafeMoon. Yeah, I'm not touching any of that. I mean, right now, crypto is now going to become so cheap that you can actually just buy like the actual majors, Ethereum, Bitcoin, Dogcoin, like whatever you want. So me personally, I'm going to probably buy up Dogcoin. Probably going to buy up a shit ton of Dogcoin, especially because we have Elon Musk on our side. So I know all you have to do is, tweet a couple times when crypto's on the rise back up, and then you're just going to make a lot of money, right? Remember when Dogcoin was a fraction of a penny and then all of a sudden went to like 10 cents and people became instant millionaires? Right? Well, I missed that boat. I'm not going to miss that boat this time around. Alright, so. Alright. Nope, he still hasn't gone live. Yeah, I mean, I can already tell. I mean, the smart money was probably like, let's wait for the news. And now they have confirmation that the thingy is up 75 basis points. Alright, so let's just see what happens. I mean, it's going to suck for me if, like, the stock markets don't actually plunge today, because I would really... Because while I was trying out unusual whales, some people bought, like, 1-week options, which expire this Friday. So those positions are all negative. So I need the market to crash so I can cash that out. Oh my god, I am not going to read this. I don't feel like reading. I'm just gonna wait for Jerome Powell. I know it's all bullshit anyway, so I'm just gonna wait for Jerome Powell here. 0.6. It seems like the Fed is actually doing an okay job holding the bond market steady. Okay, and the stock market is definitely reacting to what's happening here. Next bull run, newbies will buy the cheapest coin. Yeah, they always do that. I expect the crypto bull run to start late 2023. It will start when the U.S. debt market implodes, and it's like we've hit the bottom. Like the S&P 500 has already dropped 80-90%, I guess, or something like that. And then people decide to just go into crypto because no other choice. Aside from that, which could happen later this year or next year, we won't see another bull run until like 2020. When is the next Bitcoin halving? When does Bitcoin halve again? We're not going to see the next bull run until like, basically January to June of 2025. Because believe it or not, when Bitcoin peaked, I think last year at 65 grand, that was exactly 4 years after the 2017 peak, essentially, right? Roughly 4 years, 3.5 years. So it's going to be the same thing this time around, with the exception of this unique market event, which is, the debt implosion. So, I'm still 50-50 on that because I just don't know. I just don't know if people are going to go into crypto when everything's going down. If anything, I just think, yeah, because she actually does real estate. I don't know, man. Like, this shit's going down along with everything else. Okay. MicroStrategy is still holding steady, even though Bitcoin is like a... Great, I hit the wrong button. Even though Bitcoin's, you know, at 20,400, right? It's going below 20K. Altcoin peak when Musk appears Saturday Night Live. Yeah. Oh, that's the other thing too. Man, it's another 18 minutes. I really don't want to wait on this shit. Oh, I should probably manage my game here. Do that. I want to show you something. 5 years. Alright, look at this. Correction's supposed to be fast and hard and then over with. It's been like 6.5 months. Alright, and we've just been slowly going lower. Look, we have a double top, a triple top, and it's, you know, higher, lower highs and lower lows. This is clearly, and then of course we have the inversion in the yield curve. It's pretty obvious that we're entering a bear market, right? And the Fed knows that. That's why they're all panicking with the bond markets, because that's what the bond markets are telling you. All right, I remember 2008 very well. This is exactly what it looked like. Now, let's see if we go back. Look, see, this looks exactly the same. This is 2007 to 2009, right? Look, double mountaintop, lower highs, lower lows, and then kaboom, right? This shit collapsed. Now, this is actually pretty useful because, let's see, it didn't actually collapse until 1 year later. So it actually took a lot of time for this to happen. Yeah, because look, we had years of like, you know, this was the aftermath of the dot-com bust, right? The S&P 500 on March 11, 2003 was around $800. Then we went straight up for quite a few years during the Bush years, then double top. Okay. All right, so this is actually a pretty useful tool to look at. So basically, so it actually goes down over time. Okay, that's interesting. And then there's a grand finale at the end where you just go straight down to the bottom, which lasted 5 months. Okay. Interesting. All right. So knowing that, we go to today. This is where we're at. Yeah, I mean, we're already a lot lower. And we know that what Greg said is, you know, 80-90% correction. He said at least 80, which is conservative. So we've already been at this for 6.5 months. So so if I had to guess, it'll go up a little bit maybe. Dead cat bounce, right? Hopefully it doesn't do that. And then, you know, it'll just go down here, and then we're eventually just going to drop off of a cliff at the end of the year or early next year. But it might actually be sooner than that because, again, it really just depends on how long everyone can keep the bond market stable. So far, they actually look kind of stable. I mean, I was getting a little excited there because I saw that as soon as the Fed interest rate came out, you know, the yield started spiking, but I guess they're going to hang around here for a bit. 20% interest rate, it's like 1980. Yeah, that's what they have to do. The Federal Reserve has to raise interest rates to like at least 8.7%. But they can't do that. Yeah, I actually looked at rent in Florida. It's almost as expensive as New York City now because of, yes, inflation, but everyone's also moving there. Yeah. Rent for 1 year in Florida was like, I was looking at Tampa, Florida, was like $600 to $800. Now it's $1,300 to $1,400, and that's probably already outdated. Outdated as of a few months ago. It's bad. It's bad. And the fact that I'm seeing price increases here too, personally, it's bad. It's really bad. It's really bad. That's also why that once these interest rates get out of control, because the 30-year real estate mortgage rates are like 6.5%. Like even BlackRock and Goldman Sachs, all those institutions buying up real estate, they're not going to buy up the real estate anymore. Unless they're using all cash. They're just going to stay in cash, right? Because, I mean, why would you do that when you can just go buy like a US 10-year yield that's yielding like 10% a year? You'd rather buy that instead. So buying real estate now is probably a stupid thing to do. You'll be moving in Midwest and Florida since Midwest rent is still cheaper. Yeah, that might have to. But I'm still a coastal guy. My ancestors are always lived by the ocean, so I kind of want to live in a coastal city. So, but I mean, if I make enough money, I could just simply buy a house like for much cheaper, because obviously real estate prices are gonna have to crash. So that's what I'm gonna do. Alright, so this is actually pretty interesting to know. So 6.5 months. So how long did we have to wait on the last time? Alright, so July 17th, right? And then July 17th. Wow, this took 14 months before we had that final leg push down. Yeah, I would definitely have to buy puts and then take profit as we go down, because I thought that the crash of 2008 was just this part. I didn't actually realize it was actually a slow, steady decline that lasted 14 months before the grand finale. So let's see. If I look over here, I mean, probably another 6 to. So we're probably going to crash sometime next year, right? And that can only happen if the Fed is able to kind of stabilize the debt markets. But I don't know. They're not going to be able to do this because the Fed right now is trading short-term stability. I already tweeted this today. What they're doing today is going to reflect in June's inflation report, in July. So we're going to get like 10, 12, 14% or whatever it's going to be. It's going to be bad, and then everything's going to crash again. And then the Fed in July 23rd, 24th is going to have to raise rates like 1.25. Like the debt market's just going to keep exploding, right? And in fact, it looks like it is. I mean, right now the debt markets are imploding, but they're fighting against the Federal Reserve, who's trying to stabilize this. So I don't know. They're not gonna last. They're not gonna last. But I guess some people are gonna be okay with like, oh, stock markets went up today. Oh, everything's all hunky dory. That's not true. Oh yeah, look, the dollar finally turned positive today. Yeah, this is just it's not looking good. It's not looking good. Crypto. More Americans are moving to. A lot of Americans are moving into Mexico for cheaper rent and then work in the USA. Can you actually do that? And won't the Mexican government and people get kind of annoyed with that? Because it's like now we are invading Mexico instead of the other way around. All right, or maybe they don't mind because supposedly they'll just make more money. Yeah, I don't know. Ah, God. I think next time I'm just gonna. No, I guess we gotta wait, but this wait's killing me. All right, let's just waste some time on Twitter then. See what we got here. Actually, yeah, let me see. Yeah, it's pretty nice. Thanks to Brazil, they helped follow me for another 1,600 followers. So those base Brazilians, those blessed Brazilians in near Bolsonaro, You can always count on other conservatives out there to, help a brother out, Yeah. You know, I just don't want to listen or hear anything about crypto, to be honest. Don't care about that. Fully vaxxed pilot suddenly collapses in the toilet. Oh. Just a coincidence. Sure. That's actually really scary. Like, if you collapse while in the middle of operating an airplane, like everyone's gonna crash and die. Jeez, that's really scary. Just a coincidence, I'm sure. Sorry. Is it going in there? Dark Souls 3, that's Yorm the Giant. Internet atheism around 2011, the guy who came up with the fedora meme. I don't know why Mike retweeted that. Yeah. Am I an effing idiot? No, it's the geniuses who are wrong. I don't really see anything. Okay, what? 2024 we lit. The lowest dot is 2%, the highest dot... I never even heard of this. Okay, this probably isn't really... I don't know what this is. Sure. The Federal Reserve says they're committed to fighting inflation and will reduce the balance sheet as planned. Let me think about this. So this is going to shrink, but this is actually bullshit because if you actually look, it's actually been going up. Yeah, I don't know about that. Also, if they reduce their balance sheet, the stock market's going to crater, which of course is going to contribute to the bond markets, like, you know, blowing up here. All right, Bill Ackerman. I actually followed the guy. The problem is he doesn't tweet that often. Okay, I will retweet that. Okay. I'll read chat in just a second. I just want to read this. I don't care about that. Is this an ad? Oh, I was like, why am I seeing that? The Fed sees rates at 3.4% in 2022, up from 1.9, so 1.5%. So that's not going to do it. That's too low. You're basically saying that you're going to do 0.25% rate hikes, like, for the next 6 months. 3% up from 2.8, 3.47 points from 2.8, 2% in the longer run. The Fed expects a 40 basis rate cut in 2024, 90 basis points and beyond. Yeah, this isn't going to work. Yeah, this isn't going to work. Yeah, that's not going to work. Huh. During the pod racing scene in Phantom Menace, the crowd was actually 450,000 Q-tips being blown by fans. Oh, that's actually pretty cool. That's actually pretty cool. So, I mean, you talk a lot of shit about George Lucas, but at least he actually cared about art, right? I mean, he was a shitty writer, but especially dialogue, but, you know, you gotta hand it to him. He was a real go-getter. Now we just have Disney. Crypto companies firing employees. Yep, I know. When you expect Target Wallet, our company will do massive layoffs. I mean, I don't know. Those are retail stores, and even though they've been getting hit, the problem is commodity prices are going to go up because of inflation, which means retailers are going to make money, especially Target, Walmart, etc., because they sell commodities. So they'll be fine. Remember, retail is recession proof. So if you have to buy a stock, even though they're all going down, you buy something like Costco, right? Because hey, just like real estate and people need a place to live, you got to go to a store and buy clothes and eat food. These are things you need. You can go to YouTube, search American Mix. I'll take your word for it. SADs will reduce their balance sheet. Who's SADs? But I don't know. I can't think what central bank entity is that. I don't know who this is. Former assistant to Rudy Giuliani. She seems unusually young. I mean, she looks like she's like 20. GP Superstar is born, flips to, yeah, they're still celebrating that. Alright, I mean, it's 2:27, like, you gotta be kidding me, man. I just want to get this over with. Okay, let's do that. Alright, kind of need to go to the bathroom, too. Alright, well, from the way it looks like the Fed will be able to contain the bond yields for today. Alright, which means they'll have to keep containing it until tomorrow. Alright, well, that's how it goes. So that probably means, yeah, so the stock market's going to be positive for today. Unless, like, at the very last minute. Actually, yeah, the markets are... You know what? Maybe the stock markets are also waiting on what Jerome Powell is saying. Yeah, the dollar is very volatile right now, too. MicroStrategy is going up. That makes literally no sense. Alright. Yeah, 6 out of 14 months, so we're not even close just yet. Alright. That's good to know. Alright, let me go to the bathroom real quick and then... I hope they're not playing music. Okay, they're playing music. So I have to keep it muted. He's actually live. Alright, just in time. Alright. I actually need to eat some spinach. I need to eat that today. Damn it. It's like watching the Super Bowl, except I don't want to watch it.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high.
Right.
Against this backdrop, Today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate.
All right.
In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong.
I think that's
in contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the
Yeah. I know what
wage
you're saying.
distribution.
Well, I don't want to risk maybe this video game strike, but yeah. Yeah, exactly, yeah. SADs will reduce their balance sheet. Yeah, and not in a good way, that's for sure.
As well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation.
Of course, blame the Russians.
COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside.
This is all lies. This is not going to happen.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and...
Yeah, see? So the market now realizes, yeah, the easy money's over.
Financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting.
Yeah.
This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
Okay, so he gave himself room for 50 to 75 again next month, because that's when their next meeting is, but they're going to get screwed because, again, because they're doing so much manipulation here. Holy shit. Wow. Well, the Fed's going to be happy about this. Yeah, you're going to have a lot of inflation this month going into next month.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways.
That means this should be going up.
Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
Yeah.
We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time.
These things don't look updated correctly.
We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy.
Let's say crypto's going back up.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
So is Bitcoin at 21K
Thank you,
or
and I look
this?
forward to your questions.
Yeah. All right. Well, there you go. I mean, the market's buying the bullshit for now. Preliminary think tanks. Yeah. You know, I figured they're going to want to go with pumping shit up today. So the good news is my spider call that I still have, you know, that's probably going to do pretty well today. I don't know. I guess I'll have to see what happens tomorrow, because I only want to short when I actually see the U.S. debt market start going down while the markets are going up. You know, that'd be the ideal. Yeah. But, yeah, it's looking all right. And of course, people in the NASDAQ are having a huge, wow. Look at the markets go. You know, we're going to be looking at 2, 3, 4% today.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function.
Yeah, that's true. Alan Greenspan said
And in the
exact
current
same thing.
highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook.
Oh, we should be heading back above
and I
their
think
territory.
over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week. And we thought,
so right now we
for a
should be
while,
going
we
up,
thought, well, this is the appropriate thing to do.
Cap out, and
so then the
down.
question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside.
I'm trying to look for news here,
Some
too.
indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate.
He's going to have to do 1.5, 1.25 at least, because this is the inflation for this month is going to go through the roof. You're seeing it now. All right, we're literally borrowing from the future to pay ourselves today, just like Greg Manarino always says. So people are going to be enjoying this stock pump, right? And then they're going to get their asses handed to them probably next month. All right, but holy cow, look at that. Look at that. So the S&P 500 is definitely going to go for out of bear market territory and then above. And then it'll come crashing down once reality sets in. Because, I don't know. I mean, can the Fed just keep doing this? Just keep buying debt? I mean, I don't know about that. Crude oil is also getting hit really hard too, which is kind of interesting. That is very interesting.
At given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at
Cryptocurrencies are
a
back in style
modestly
for a little while.
restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is.
Actually said he was
but so
buying
that is
Bitcoin
generally
as a
a
short-term
range of
play.
3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
Steve Leishman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look
how they don't
at
mention the
asset
debt
prices.
market
You can
at
look at
all.
the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine, and
crops farmer now going up because of
and
this?
the fallout from that, and also just all of the supply side things that are still, pushing
it's
upward
actually
on
increasing.
inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done and breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at a broad range of inflation expectations,
Good question.
So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
This is actually a good.
I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then
Jerome Powell
pretty soon we'll be in an area where we're.
He couldn't say that.
I think as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Thanks, Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be, any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out. And that's what we're looking to see. And if we don't see that,
Again,
then
this is why-
that's the kind of thing that will cause, even if we don't see progress for
When
a
everything
longer period, that
crashes,
could
I don't
cause
know
us
if
to
crypto's
react.
going to go
But
up.
we will soon enough, we will be seeing some
following
progress
exactly
at
what
some
the
point.
stock markets are doing.
And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some
Oh,
data
gee. Yeah.
late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby.
Oh, my
Thank you
Amazon
so much for
package
taking our
here.
questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
So the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make that you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course,
The most
of
important part of
commodity
this data is
prices,
not
the
here.
war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take, for example, in the labor market. So you have 2 job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So
chart's really
effectively
annoying.
what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could
See, look at this. Because I remember in an old video I did this analysis before. Silver is actually going down. October 2008, just like the markets are going down. All right, and it bottoms out on March 2nd, 2009. Yeah, it's following exactly the freaking stock markets. I don't know. I would not want to be holding crypto, I think. I think it's just going to go down like everything else, especially if cryptocurrencies are going up and down the exact same way with the stock market, especially the NASDAQ. So in that case, the only winning move would actually be... Was PDBC even... was this even in existence back then? Click. And then click 5 years. Yeah, this didn't even exist back then. I don't know. It just seems to me that having cash will always just be a much better move. Yeah, we're just gonna hold cash. This is the one time I actually break with Greg Manarino. I would not want to be in cryptos. I mean, I'll still have it because obviously I have DeFi positions, so I have to have crypto anyway. But I would definitely just keep cashing out. Nothing wrong with just holding cash.
see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationship.
I think I'm gonna end the stream because the questions have slowed down pretty much, and like Jerome's just answering stuff that don't matter. So, I still have to do stock stuff, but I think I'll try to make some videos tomorrow, and then I'm gonna like scale back doing stock market stuff just to like free up my time and attention again. You know, which is difficult because since I know the markets are probably gonna be up this month for the next couple of weeks, maybe I want to buy some calls. So I don't know. I guess I'll figure it out. Let me see. Yeah, markets are up, whatever. So, yeah, I mean, I guess we'll see how it goes. Or I might just do the simple thing, just buy PDBC. So, I don't know. Either way, I think we're done for today. So I'll see you all tomorrow. Thanks for watching. You know, like, subscribe, share this video around. Tell all your friends, you know, about this channel. And of course, thank you to all the old and new people watching. So. Yeah, we'll get back to a somewhat normal routine starting tomorrow. So back to good old crypto. And yeah, because crypto I think looks like it's kind of coming back just a little bit. You know, maybe we'll have a couple more crypto projects to deal with. But yeah, but you know, 10-year yield. I mean, for now, it looks like the Fed's, you know, the central bankers' attempts will work, right? But you know, again, comes at the cost of just much more inflation. You know, this month, which will be reported early next month. So, all right. I'll see you all tomorrow. Thanks for watching. And actually, yeah, I think I could just leave it like this. I don't have to change